Financial assets play three fundamental roles in modern economies. To appreciate their importance, think for a moment on the complexity of economic activity. Millions of households and firms interacting in a decentralized way to produce and distribute a countless number of goods and services. The productive process involves the use of machinery, buildings, and other real assets, and generates an infinite number of transactions among firms and between firms and households. All these real assets and transactions have a mirror image in the financial world. They translate into financial assets that convey ownership over physical assets and also over physical goods and services. For that reason, financial assets facilitate the transfer of ownership and the exchange of goods and services in modern economies. The second role of financial assets is equally important. They permit the store and transfer of wealth and liquidity. This allows firms and households, and also governments, to disconnect their stream of revenues from the payments associated with their consumption and investment decisions. Thus, firms, households, and governments have the option to save part of their revenues today to pay for their consumption and investment in the future. At the same time, financial assets also allow firms, households, and governments to consume today by borrowing with the promise of repaying in the future. A third role of financial assets relates to the transfer of risk over time and also between parties. With the help of financial engineering, a wide and sophisticated range of financial instruments allows the separation of specific risks, their transfer, their pricing, and more important, their management. These are fundamental roles highlighting the importance of having well-functioning financial markets. These markets bring together various types of investors and borrowers and facilitate the trade of financial assets such as stocks, bonds, and commodities. Let's take a look at them. Financial markets are frequently classified in two broad classes: capital markets and money markets. This distinction is based on the time horizon of the instruments traded. The capital market focuses on the trading of long-term assets. These are assets that have a maturity higher than 1 year. In turn, the money market focuses on the trading, exchange of short-term instruments, which typically have maturities lower than 1 year. Let me now talk a little bit about capital markets, which are the most widely followed markets. They comprise the stock market and the bond market. Institutions tap the capital market to raise funds for mainly long-term purposes. Industrial corporations, for example, may issue equity in the stock market and long-term debt in the capital market at the same time to try to finance their long-term operations, expand their business lines, finance their investments. Federal and local governments also issue debt in the bond market, but only in the bond market. They don't issue stock. And they use this debt to help finance their expenses. Investors in the capital market, taken as a group, operate as net lenders, albeit they typically engage in both buying and selling securities. So they bring cash into the market. On the other side, institutions that issue equity and debt in the capital market are net borrowers. The flow of money in net terms goes from the net lenders, so the investors, to the net borrowers, firms and governments. Now, it's important to realize that the borrowers raise money only when they place the equity or debt for the first time. That is, when they issue the primary instrument. This market is known as the primary market. In turn, securities already issued are traded among investors in what is called the secondary market. Now, capital markets are risky, and they are not typically suited for short-term investment. And this is where the money market comes to play. So what is a money market? It's a market for the placement and trade of short-term fixed income securities. Typically, when we talk about fixed income securities, we tend to think about a bond. In practice, bonds are fixed income securities. They belong to the same group. But there are some other classes of fixed income securities that are issued and traded in the money market. And we will be discussing this in the next videos. For example, the so-called T-bills are a particular type of security issued and traded in the money market. Certificate of deposits, repos, and some other type of instruments and operations are fixed income securities that pertain to the money market. Let's now talk a little bit about the main characteristics of the money market and the difference between the money market and the bond market. Well, as I was mentioning, the money market specializes in the issuance and trading of short-term securities. Bond markets are long-term. So, for that reason, for the fact that they trade short-term instruments, money markets are called sometimes cash investments. Money market investments are called cash investments. So money market securities are essentially IOUs issued by institutions, including large corporations, financial institutions such as banks, and also by governments. These securities are very liquid and very safe, and these two characteristics are the main appeal for investors. Let's now turn to the participants of the money markets. Money market participants are typically institutions. These include banks, other financial companies as well, such as insurance companies operating in the money market. Money market funds are also key participants in the money market. Large corporations issue short-term debt in the money market, and as we already mentioned, central banks do conduct monetary policy operations by using money market instruments, and governments, both local and central governments, issue short-term liquidity or deposit short-term liquidity using the money market. Money markets have two salient characteristics. First, they are typically a dealer market. So this is in sharp contrast with the stock market. A dealer market means that firms buy and sell the securities on their own accounts and at their own risk. In contrast, the stock market, brokers receive commissions to act as agents, but investors take the risk of holding the stocks and the bonds. The second selling characteristic of the money market is actually the lack of a trading floor. Money market deals are typically transacted using electronic systems or sometimes over the phone. To conclude, let's discuss the general characteristic of money market instruments. As we mentioned, they are short-term, they mature in less than a year, they have very high liquidity and low risk. These two facts combined generate that they also pay a very low return. An additional characteristic of money market instruments is that they are typically issued in very large denomination, so investors do not generally have access to these instruments by themselves. They have to purchase or sell these instruments by using securities dealers. Throughout this video, we cover the role and the nature of financial instruments and markets, emphasizing the differences between the capital and the money markets. In the sessions that follow, we will talk about specific characteristics of the most common money market instruments.